All right, check, radio check. Welcome everybody. Chris Lester here, your speaker presenter today. I want to thank all of you for taking time out of your day to hop on our weekly chat with Chris. Market update. I've been doing these for 2 years now, and there's definitely some turmoil in the marketplace. So, what does that mean for everybody on the call? You'll often hear me say that this is not about making emotional decisions. This is not about trying to be reactionary. The challenge that I have as an advisor is quite often, folks might be on this call where they have either no advisor, maybe their advisor is through their plan design, 401k, TSP, or something that their company offers, or maybe that they're just doing it themselves and they're uncertain what to do or how to proceed. So when I give advice, right, it's general in nature, but I have some strong opinions. And part of what this philosophy is allow us to look at what's happened recently in the past month, and then year to date. And then based on what we see, what do we see coming in the near future? Again, none of us have a crystal ball, but taking an approach of more of a strategic approach to the market can help to stem the emotional swings that we can often feel. Last month, I talked about that we had gone above one of our indicators above 50, saying that we're heading into recessionary territory, right? And then, the markets, one day the market's saying the sky is falling, the next day everything is great. So, what to do, how do we do it? And what I often will say is that, look, you just have to have a plan in place. There are things you can do to reduce market volatility. Market volatility is here to stay. It is part of our overall environment. Now, when our assets consist of equities in our 401ks, TSPs, in the market, brokerage accounts, depending on the diversification that we have, we're going to see that different sectors, different indices are going to react differently. And then as we approach near and actually enter into retirement, right, the balance of our portfolio may act differently as well. One of the folks that's on this call, I was speaking to her earlier this week, it gives me great comfort to know that the strategies that we put in place have a 0% loss probability, right? Because we put mechanisms, tools, and strategies in place that do not subject her to market risk. But she's a little bit older. Some of the folks that are on this call are still in their working years. They're still in the what I call the accumulation stage. So having this frame of mind and understanding that whatever you do, don't panic. I would also encourage you to turn off the news, right? It is filled with, it sickens me. That one day it's, this crisis, next crisis, it goes from crisis to crisis to crisis. It's a wonder that any of us have made it this far. So I try to be a glass half full type of personality. I try and share hope and optimism, but, to do so from a basis of planning and with strategy so that we don't have the worry that is so often ingrained in our environments today. So without further ado, welcome to the call. It should be relatively brief. This will be good news compared to what some of us went through in June. But as I look at this slide here, we look at the indices for June, which is technically July. It's the last day of June and the last day of July. And we'll see, hey, for a 1 month snapshot, all the indices were up. And that is contrast, or there's two of them, China, the emerging growth, a little bit down. And then I think that's commodities, right? Was a little bit down as well, the gold, right? But for the most part, where most of us have our money, right, in the indices, you may have seen your accounts recover, which is great news. Some of you are like, whew, it's coming back. I knew it would. Perfect. If we just remember back just 1 month ago, when we were sharing the June slides, the June update, this was almost opposite. So we're just basically treading water right now, right? So, as I look at the accounts on a regular basis, I see the volatility as well. But year to date, we've been under pressure for the whole year. And that's not surprising because, again, we had Ukraine invaded by Russia. We're coming off the COVID, and now they're renaming monkeypox, right, for PC reasons, right? But, viral epidemics, pandemics, things of concern. And then, global risk, right? China is really starting to rattle their sabers, and the markets are concerned there, right? We had inflation, right? We have spending bills passed. We have supply chain shortages. It's just been 2022 has been an extremely challenging year, but I'm actually pretty impressed with its resiliency. Now, with that said, and I said at the beginning of this year, right, that I am concerned for third and fourth quarter because although we've had technically into recessionary arenas, I don't think that that we can't have another pullback. If we're not out of the market, we don't sell. Over time, market history has shown that we will recover. But when you look at some of the indices here and you see down, negative 10, negative 15%, it's not the end of the world, right? You go, oh, that's not so bad. But you go back to, like I said, into June, it was a pretty rough month. In year to date, it's still a challenge. But, from a planning standpoint, we have to say, hey, why are we in the markets in the first place? Because we're looking for growth. And one of the advantages to when we're with an employer and we have 401ks and we have 457s, we have TSPs, we have these mechanisms in place. One of the things that they allow us to do as Americans, as investors, as plan participants is to dollar cost average into the market. So that allows us to take advantage of buying when the markets are down on a weekly, bi-weekly, monthly basis. And that is taking advantage of buy low and hopefully sell high, which is a recipe for making money. So when we're looking at our statements, one of the worst things we can do is make knee-jerk reactionary changes. Now, we've talked about in the past, right? Asset allocation, adjustments, should we be 60%, 70% equity, less or more? And if we're in a sort of a pre-designed asset allocation model, where do you go to? And that's the challenge, right? Is that quite often we don't have, through the plans that we're participating in, any other options. And again, this is where an advisor, somebody like myself, maybe you're on the call invited by one of my other advisors, if that's the case, we can start to put other strategies in place that will A, further diversify, and B, reduce the risk. So this was a repeat of some of what we've done year to date. We've just crossed over the halfway point. We got about 4 more months left in this year. But I do think that heading into September, heading into October, and especially November with the election coming up, that we could see challenges for, towards the end of the year. The housing market has cooled off. Energy prices, although oil has come down and we go, whoo, right? The markets, inflation is still there. Things are more expensive. I hear little tidbits of, well, this item. I saw the other day somebody posted in one of my neighborhood chats, hey, Acme had no chicken, right? Well, one of my clients lives down in Delaware. He goes, I got chicken everywhere. We got Tyson, we got Purdue, we got all and there's no shortage, right? But what happens is again, it's the cost of getting it from point A to point B to your grocery store. And then when you go to need it, use it, or want it, and then when you finally do find it, are we paying 10%, 20%, 30% more for something? So, those are the types of things we have to be aware of as we go forward. So the sky is not falling. Being in the market involves risk, and you have to be comfortable with that risk. But again, as we approach retirement, dialing back that risk and preserving more of what we had or have accumulated is prudent. This is our bull bear indicator, and you see the red line. We still have, or we're on a downward slope here. Even though we've had this bump up, it doesn't mean it can't continue to slide. When we had it last time in the flash crash of COVID, I recommended to most of my clients to stay put. A lot of my clients now, we put strategies in place that we know that, hey, look, we're going to be subject to some of this equity risk, right? But until things get better, it doesn't mean that we don't throw our baby out with the bathwater, right? We don't panic, but we also start to look at other strategies to balance out the portfolio. That's where you'll hear me talk about structured notes, right? I really do think it's another alternative. They've been very helpful for a lot of repair to a lot of my clients' portfolios because right now the 1 year notes, I think for July's went off at 12.6% for the euro. And then, for August, I think we're getting ready to close on those are 11.4%. And, to have that as a bond alternative, we're going to talk about that. But the thought process is, hey, if I can get that coupon to come back in and recoup some of what was lost on this downswing, not allowing us to panic, that's where strategies can have a big play. So, this is just sort of us as it's a tracking map. It's an indicator. It's sort of, hindsight being 2020, but you can see when things go down, this is, hey, 2008, we were all familiar, 2009, we definitely don't want that to happen. But if you have strategies in place where if this did happen, you want to make sure that you catch it on the way back up. So that's on the equity side. So now let's talk about income. And now the income indicator, notice that all of these had a positive month for July, right? So if you're in the income arena, you're a little bit older, your portfolio, we need the income, we were looking for yield, right? That actually July was a good month. On a 1 month observation, you go, oh, wow, okay, we can make some money. But when we go back and we pull back out and do more of a macro view of the year, we can see everything is still down globally, right? All the income generating sources have been under pressure, and we've talked about that. So two things. A, if you had an income portfolio following traditional wisdom where you needed to pull off a yield off of your income-based assets, right, that you were generating revenue and you got $1 million, you needed 50 grand a year and you're down 5%. Well, now you're down to 950, right? $950,000. And now you're going to pull off another $50,000. You're not replenishing that. So that now that's where that slow bleed can come in and decimate or deteriorate a income-based portfolio. And that's why, again, I've been suggesting structured notes sort of as this income alternative. I still have clients that have diversified portfolios getting income, but they are challenged. They're extremely volatile. And you have to at least understand that that is the risk, right? That when we're in income based, so when you get your 401k statements and you're sitting at your desk or your cubicle at work and you're going, where do I put my money? Remember, the 401ks have very limited selections. And you're going to look at this and go, well, this one's been up 10% in the last 10 years. Well, that's not necessarily a good barometer. What's it done in the last year? Because remember, income portfolios typically don't like rising interest rate. And I think everybody on this call knows that interest rates have been rising. So, when we look at the bull bear chart here, this continues to be a red line and probably will be for a while, right? So it's just, again, why I caution about, that whole traditional theory of 60-40, 50-50 as we enter towards retirement. I'm perfectly okay being in the equities and diversified amongst those different asset classes and sectors. I give pause to income-based portfolios, and I'm a strong proponent of looking for other areas to protect that half of our portfolio and take less risk to get a reasonable rate of return. And that can only be done with two things as far as I'm concerned: annuities and structured notes. If you have questions, you want to see what that looks like, we can certainly discuss. And then this is the last one. Last month, we went to 53. You see this bump here? This is a recession probability analytic tool. It was created by Formula Folios. It takes 100 data points. It can take inflation. It can take the jobs outlook. It can take, just housing markets. It takes a lot of data, runs it through a series of algorithms that it was created for, and it spits out a number. 50 is our middle point. If we cross this 50 line, that means that we're heading into troubled water, turbulent water. Now, I'm ex-Navy, and when I'm out on the ocean, right, you see storm clouds in the horizon, right? We know that, hey, buckle down, we lock everything down, we stow the gear, and we make sure that we're ready for turbulent times. Now, the good news is here, this happened in July, and for August, we're now at 47. We've dropped below it. Okay. That doesn't mean we're celebrating, right? Because we came off this pretty smooth line and we saw that spike up. I don't know what's going to happen, right? I don't know what's going to happen with Taiwan. I don't know what's going to happen with inflation. I don't know what's going to happen with the election, but we are close and hovering around some dangerous and troubled waters. So I just encourage, hey, be a little prudent. It probably wouldn't be the worst idea to have some cash on the sidelines. So if the market tanks, if indices tank, whether that be equities or income-based strategies, that you're in a position and you don't want to take, let's just say for roughly, you got $500,000 in your 401k and you're in a 60-40 split, right? So you said, hey, listen, I got $350,000 in equities, I got $150,000 in an income portfolio, that 150, and you say, I'm going to move that to cash. I didn't give you that advice. I just want you to understand the thought process. If you elected to do that, you need to have two things. A, if you're going to exit the market, you should give thought as to a re-entry strategy. What's your strategy to get back into the market? Are you going to turn around and dump it in next week, next month, 12 months from now? I don't know. Timing the market, there have been exhaustive studies showing that you cannot time the market. If you're going to take an approach where your concern, your gut instinct, your intuition is saying, listen, it's showing you it's saying, hey, I want to pause here. If you do that, at least have the discipline to say, I want to have some type of re-entry strategy. Quite often with my clients, what we'll do is, hey, over a 5-week period or a 5-month or a 10-week period or a 10-month, that we're just systematically dollar cost averaging, much like you do with your 401k, back into the market. It's not that it's proven that it's, hey, Wednesday's better than Tuesday. None of that has any bearing. The reason we do it is because it takes emotion out of it and it allows us to be somewhat automated, right? Because none of us are robots. As much as you can see us moving towards a robotic type environment and everything's automated for us and everything's, simple, and we don't have to worry about everything. With the financial arena, we have to take care, and we want to make sure that, hey, listen, once you've earned that money, once you put it away, once you say, hey, listen, I want to take and allocate this for my future retirement, we have to be good stewards and protect it as best as possible. So folks, that's my speech for today. I want to thank all of you for taking time out of your days, listening to me on a weekly basis. Next week, keep in mind, we will do part 3 of our wills and trust strategy. If any of you need me, there's my office number. You can always call me on my cell, send me an email. Happy to talk to you. But for those of you I haven't talked to in a while, I want to say hello. Hope all is well. For those of you that don't know, today's my birthday. I made it to 38. No, I'm 58 today. So I made it. One of my clients, I'm like, how did you know it was my birthday today? And he was like, I have my ways. I'm like, wow, that's somebody kept good notes. So, I really do appreciate all your support. I'm here to help any way that I can. And sometimes that doesn't necessarily mean that there's a transaction involved. I'm happy to help, just making sure that whatever questions you have, especially when it's related to finances, that we can be of service to you. So folks, have a great day. If you need me, reach out, and I'll talk to you soon. Bye-bye.